March inflation came in higher, with much of the increase driven by a spike in energy prices, adding yet another layer of pressure to an already sensitive market. At the same time, updated home price forecasts continue to highlight a familiar theme. Despite shifting rates and market uncertainty, home ownership remains a powerful wealth building tool. Good afternoon. I hope you're off to a great start to the month. It's hard to believe we're already halfway through April, and things are continuing to get interesting. Last week brought a wave of new economic data, including updates on inflation, the labor market, and the overall health of the economy. At the same time, as we approach the midpoint of the current 2-week ceasefire, uncertainty remains elevated following unsuccessful peace talks over the weekend. From both economic and global perspective, investors are continuing to weigh potential outcomes, and that ongoing uncertainty is what's driving the volatility we're seeing in the markets. On the brighter side, we've seen a slight shift in momentum in a positive direction for mortgage rates. The 10-year Treasury opened this week at 4.27%, down from 4.37% last Monday. Let's dive into what took place last week. Here are your headlines. The latest inflation data from the Consumer Price Index, or CPI, showed prices picked up in March, rising 0.9% for the month and 3.3% year over year, up sharply from the 2.4% previously. The increase was largely driven by higher fuel and gasoline prices tied to the Iran conflict. Now, core inflation, which excludes food and energy, remained more moderate, rising 0.2% for the month and edging up to 2.6% annually. We also received February's Personal Consumption Expenditures Index, the Federal Reserve's preferred inflation measure, which had been delayed due to last fall's government shutdown. The report showed broad-based price increases, which is a bit surprising given it reflects data from before the March oil spike. So what is the takeaway? The initial spike in mortgage rates at the start of this conflict was largely driven by investor concerns that any disruption in oil supply would fuel inflation. At the same time, the Federal Reserve held its benchmark Fed funds rate steady so far this year, following 3 rate cuts late last year. Minutes from the March meeting showed that while still a minority, a growing number of officials are open to the possibility of a rate hike if inflation remains elevated, an increase from what we saw in January. For now, the Fed remains in a wait-and-see mode, closely monitoring how inflation trends and the broader economy continuing to evolve. Now, in housing news, home prices remain stable from January to February, according to Cotality's latest home price insights report, with values up 0.5% compared to this time last year. The longer-term trend is encouraging. Looking ahead, Cotality projects home prices will climb about 4.7% over the next year, an uptick from their previous 4.4% forecast. So what is the bigger picture? It's another reminder that real estate tends to move in one direction over the long run. On a $500,000 home, just a 5% increase in value would mean roughly $25,000 added in equity in a year. Now for a snapshot of our economy, the GDP, the final reading for Q4 2025 shows that U.S. economy grew at an annualized rate of just 0.5%, a sharp slowdown from 4.4% in Q3 and slightly below the previous estimate of 0.7%. Much of the decline was tied to reduced government spending during the shutdown. Markets opened the week on a positive note yesterday, with hopes that recent rally can continue as tensions begin to ease. Looking ahead, this week focus shifts to housing and inflation data. March's existing home sales was released yesterday, followed by April home builder confidence on Wednesday. On the inflation front, producer price index was released this morning with a fresh look at wholesale pricing pressures. And Thursday brings the latest update on jobless claims. I'll be in touch next week with an update on what takes place. But for now, great rest of your day.